As 2012 comes to a close, everybody's looking to see what 2013 holds for the markets. I'm here today with Michael Gayad from the ATAC Inflation Rotation Fund. Michael, the S&P 500, it's up about 15% so far year to date. We only have a handful of trading days left in 2012. What are you expecting for 2013?
Well, clearly we're very close to new all-time highs. You need roughly 6% more in the Dow for the Dow to make new all-time highs. Now, as asset allocators figure out how to position their money into next year, I think there's going to be a consensus going on. Bonds are expensive. The income trade is very pricey. Meanwhile, capital appreciation, equities, the cyclical trade is comparatively cheaper. Now, if you see a reallocation, which has been a theme of mine, admittedly has not happened yet, but if you see that beginning first quarter, there is no reason why markets cannot continue this uptrend despite tremendous skepticism by the retail public.
Yeah, will fundamentals be able to support the trade into equities?
It's a chicken or the egg issue as far as fundamentals. Equities can create a better fundamental environment rather than just discount it. This is something Alan Greenspan has made a very big point about. Now, if markets continue to rise, the idea is that there's something called the wealth effect, which makes people feel better, feel like they can spend more. Rising collateral values, that makes people spend, that causes kind of a self-fulfilling growth cycle in the economy, which can impact earnings positively. So we could be in a situation where the market itself becomes far more important, far more stimulative, which creates a better environment in 2013.
Do you think it becomes more stimulative at the end of 2013 in the second half, or will we see it right away at the beginning of the year?
You know, the trend is your friend until it ends, and I think it's the odds favor continuation in the near term. Now, when you look at emerging markets and you look at Europe, a lot of these areas which nobody bet on have a lot of room on the upside to move to catch up to the U.S. stock market. I suspect you can see a lot of that movement in the first half as really money starts to say, you know what, maybe the end of the world isn't coming. Maybe we should actually start to bet again on risk.
So those are some of the regional areas we would look at. What are the sectors that you have your eye on domestically?
Financials continue to show very good strength, not just in the U.S., but also in Europe. If you look at the European Financials ETF, EUFN, that's north of 40% since the late July low. But I think really the most interesting spot is going to be anything that's cyclically and inflation sensitive. Those really are materials, industrials, anything that's much more overseas oriented rather than domestic. If you look at what's happening, discretionary stocks are weakening at the same time that emerging markets are strengthening.
There you have it. You heard it here first. 2013 is going to be a risk-on trade. You're going to want to get into equities. I'm Lindsay Bell with The Street.